Wall Street threw an absolute tantrum over their margins last quarter, but it turns out renting out aging computer chips is actually a brilliant business model. Welcome to Earnings Unscripted. It's August 11th, 2026, and today we're unpacking a really wild second quarter from CoreWeave, ticker CRWV.
Right, because that prior panic was just a timing mirage. You have to physically build the AI data center first, which completely wrecks your income statement, and then you finally start leasing the servers. This quarter, we actually saw the rent checks clear. Adjusted operating income basically exploded from $21 million last quarter to roughly $128 million sequentially.
That's exactly the flip. So they pulled in $2.58 billion in revenue for the quarter, and their adjusted net loss narrowed comfortably past street consensus. The tape absolutely loved that leverage. The stock drifted down into the regular close, but then surged more than 18% in extended hours.
Well, they proved the core unit economics are actually stabilizing.
Yeah, though honestly, treating extended hours tape as gospel is a fantastic way to go broke, so please treat everything we discuss today as just our personal perspective and absolutely not financial advice. But Miro, this wasn't just accounting magic. They physically scaled their infrastructure up hard to hit those margins.
They really did. We were openly questioning their internal operational friction last time, but they brought an absurd amount of active data center power online. We're talking hundreds of megawatts deployed rapidly in just a few months. That instantly expands their revenue-generating base against corporate overhead.
Right, and the customers plugging into that infrastructure aren't just, scrappy tech labs testing theoretical models anymore. They mentioned Caterpillar using their cloud network to run a massive industrial data factory, basically iterating the software inside autonomous construction gear. That's heavy industry getting involved.
It's the true monetization phase, yes, but what actually caught my eye isn't the shiny new hardware they're selling to Caterpillar, it's the zombie hardware. They're somehow convincing customers to sign massive extensions on legacy graphics cards originally launched back in 2020.
Wait, they're locking in new contracts on infrastructure that should functionally be obsolete by now. Okay, I need to know exactly how they're extracting premium margins out of fully paid off hardware, because that completely breaks the standard tech depreciation curve.
Because standard accounting assumes these chips turn into pumpkins after a few years. But they're taking their older fleet, specifically those original A100 chips from a few generations back, and recontracting them. They paid off the associated debt on these long ago. Now they just rent them out at high prices, which turns that capacity into a pure cash flow engine.
Okay, wait. Walk me through that. Why would a customer sign a fresh contract for older technology? Are they just completely desperate for compute?
I mean, workload matching, mostly. Not every AI task needs the absolute bleeding-edge hardware. Some models run perfectly fine on older architecture if the math makes sense. And the wild thing here, the pricing power holds up. I think CEO Mike Trader said it best on the call. He said, and I quote, "The fact that we have been able to go ahead and sell a GPU whose architecture was from 2020 in a contract that was fully priced out to 2029 really provides some insight into what the future is going to look like."
That timeline's genuinely ridiculous. And it sounds like they pushed a fairly aggressive price hike recently, too? Roughly 25% across their existing inventory in July?
Right. So you layer that price hike onto fully depreciated assets and your margins naturally soar. But here's the thing. That legacy margin story's great, but their shift in how they finance the new builds is structurally way more important. They secured this new debt facility, a delayed draw term loan.
Oh, sure. So they basically just bumped up their credit limit to float all the massive new data center builds.
No, that's not quite it. It has less to do with the total limit and everything to do with the duration they're allowed to collateralize. Previously, the debt markets forced them to back their loans with guaranteed 5-year contracts from massive hyperscalers. You needed that long, steady lock-in to get the cash to build. But this new facility allows them to secure financing against shorter 2 to 3-year enterprise deals.
Ah, got it. So they basically broke the hyperscaler chains. They can now chase regular corporate clients who absolutely refuse to sign that massive lock-in, but will gladly pay a huge premium for a shorter deal.
Exactly. The short-term premium yields much higher contribution margins, which explains why their new managed inference business, essentially providing the runtime platform for these models instead of just raw compute, leaped from basically a pilot phase to over $100 million in annualized revenue in a single quarter.
Moving from testing to actual production? They mentioned algorithmic trading firms using their network to build quantitative models because the latency protection is so tight. That kind of real-world deployment definitely justifies the enterprise premium.
It does, but I feel like we're ignoring the elephant in the balance sheet. All this scale requires staggering capital. Their capital expenditures hit roughly $9.4 billion in the second quarter. The cash burn pace is unprecedented.
I mean, they did just pull in massive new funding across debt and equity to cover the runway, right? I saw they have a massive pile of cash and marketable securities sitting there.
Yes, liquidity's strong on paper, but the debt carries a nasty bite. All those borrowed billions push their quarterly interest expense to about $640 million. Think about that. That single line item completely dwarfs the operating income we praised earlier. The debt load's just swallowing their operational profitability whole.
So as long as the hypergrowth persists, they can outrun the interest payments. But what happens to that crushing debt load the moment utilization drops or customer demand slightly normalizes?
Well, that's the absolute nightmare scenario. If utilization actually slips, that interest load becomes a very real trap. But management argued that external friction, like all those local moratoriums blocking new data centers, is essentially protecting them. It constrains total market supply, so they're basically using their pre-secured power agreements as a structural moat to keep pricing ridiculously high.
Right. So the local red tape actually rewards the operators who already plugged everything in. It's wild that access to electricity is literally trumping real estate right now. But how confident are they that this momentum holds up? What are they projecting for the rest of the year?
They're aggressively confident. They just bumped their full-year revenue expectations up to a midpoint of around $12.8 billion. Plus, they mentioned adding over $25 billion in net new customer commitments in just the first few weeks of the third quarter alone. That wasn't even in the backlog we just talked about.
Wait, back up. A massive wave of fresh commitments hitting right after the quarter closed? That completely proves their shift to enterprise customers is paying off. But to actually deliver on that pipeline, they have to keep buying hardware. Did they raise the capital expenditure targets?
Yeah, significantly. CFO Nitin Agrawal revised full-year CapEx guidance to land somewhere between $35 and $39 billion. It's a staggering figure. Their whole philosophy is that if you secure the customer contracts first, the credit markets will happily fund whatever it takes to construct the physical servers.
It's just growth by pure brute force, isn't it? They're effectively treating compute capacity like prime real estate. If you hold the power agreements, you own the toll booth for the entire AI transition. It's definitely risky, but you really can't help but respect the sheer scale of the ambition.
Exactly. As long as the execution stays sharp, the math works out perfectly. We'll see if they manage to maintain this pace next quarter.
Very true. We'll be right here reading the fine print so you don't have to. Thanks for nerding out with us today, guys.
Always a pleasure. Catch you later.
If having these breakdowns pop up on your feed helps you out, hitting follow is the easiest way to catch the next one. Just to be totally upfront, we're actually synthetic voices, and this entire episode's an AI-generated project, turning today's massive CoreWeave filings into a podcast just hours after the call. We really love to hear how it's landing or what ticker to tackle next. So shoot an email over to earningsunscripted@datamadness.ca or grab that X link in the show notes.
Thanks for hanging out, guys. See ya.